Welcome to today's explainer. Right now, the market is literally defining the word crossroads. We are watching this fascinating, incredibly high-stakes tug-of-war play out on Wall Street. On one side, we've got the absolute thrill of fresh record highs, and on the other, these dark clouds of rising economic risks. So, are we going to see the market break through an unprecedented ceiling, or are we staring down the barrel of a sharp reality check? In this explainer, we're going to break down the exact data points driving both sides of this battle so you can understand exactly what's moving your portfolio.
Okay, let's dive into our roadmap for today. We'll be covering the state of the market, the case for 8,000, that massive valuation elephant in the room, and finally, the ultimate catalyst. Starting right off with Section 1, the state of the market. 13%. That is the year-to-date growth of the S&P 500. Honestly, in most years, you'd be absolutely thrilled to get a 13% return over 12 full months, let alone where we sit right now. It's absolutely crucial we establish this massive baseline momentum. The market hasn't just been inching upward, you guys. It's been running. And this powerful momentum is the foundational force that the current risks are fighting against.
But you know that momentum? It's brought us to a really fascinating standoff. What we're actually tracking right now is a tug-of-war between two totally distinct mindsets. On one side, you've got AI euphoria. These are your optimistic tech buyers who see a fundamental transformation in how businesses operate, and they're willing to pay a premium for it. But then on the other side, you've got inflation jitters. These are the pessimistic macro watchers who see stubborn prices and fear that the whole easy money era is over. The entire market right now is caught squarely between these two opposing gravitational pulls.
So let's look at how this tension is playing out in real time. The index closed last Friday at a super strong 7,757.64, but today we're witnessing a slight pullback to around 7,736. And you might be wondering, why the sudden dip? Well, it basically all comes down to energy. Oil prices just jumped 2.4% due to rising Middle East tensions. And as we know, when oil spikes, inflation fears instantly flare up, giving the inflation jitters camp a very quick advantage in our tug-of-war.
Now, what's really interesting about this is how the broader market is interpreting those inflation fears when it comes to interest rates. You hear folks out there assuming a rate cut is just a done deal, right? But looking at the actual data, traders are only pricing in a surprisingly low 44% probability for a September rate cut. The majority, 56%, are betting the Fed just holds steady. The market is clearly nervous that the Fed won't have the inflation data it needs to comfortably lower those borrowing costs.
So if everyone's so nervous about rates, why on earth are they near all-time highs? Well, let's get into Section 2, the case for 8,000.
The answer is actually pretty simple. Corporate earnings. Earnings are the absolute backbone of this rally. Get this, a staggering 85% of companies are beating their Q2 earnings estimates. That is way above the historical average. The bottom line here is that despite all the inflation fears, American companies are making serious money. And at the end of the day, stock prices follow earnings. This fundamental strength is the anchor for the bulls right now.
And this brilliantly illustrates how those strong earnings are completely shifting institutional outlooks. JP Morgan just officially raised their year-end target for the S&P 500 to that magical 8,000 threshold. Why? Well, they're specifically pointing to heavy AI capital expenditures, meaning companies are investing massively in the future, and importantly, broadening market participation.
And you know, that phrase, broadening participation, that is absolutely crucial here. For a long time, the whole narrative was that just a handful of massive tech companies were dragging the rest of the market up with them. But here's the real game changer. The equal-weighted index is actually outperforming the megacaps right now. This means it's not just the big tech names winning anymore. The rally is spreading like wildfire to the rest of the economy. When the average stock starts beating the giants, it signals a much healthier, much more durable rally.
But look, as strong as those earnings are, we have to talk about the heavyweights dragging on the market. Let's move to Section 3, the valuation elephant.
To really grasp the risk here, we need to look at the Shiller CAPE ratio. You probably already know this is our ultimate reality check. It smooths out the business cycle over 10 years of inflation-adjusted earnings, basically telling us if stocks are genuinely cheap or wildly expensive.
And well, here is that reality check. The CAPE ratio is sitting at a sky-high 42x. This is that elephant in the room I mentioned. To put this massive number into perspective for you, the literally only time in history we have ever seen higher valuations was during the absolute peak of the dot-com bubble. This is exactly why the bears are being so vocal right now. You can have great earnings, sure, but if the price you're paying for those earnings is at historic extremes, your margin of safety is practically zero.
Now combine that historic valuation with what the technical indicators are flashing. The bullish percent index is currently sitting above 70%. In the technical analysis world, that level signals heavily overbought conditions. When you have .com level valuations sitting right alongside overbought technicals, the market becomes incredibly fragile. Any piece of bad news could easily trigger a sharp, sudden wave of profit-taking.
So we've got this perfect storm of high momentum versus fragile valuations, which leads us right into Section 4, the ultimate catalyst.
So the crucial point in all of this is Wednesday's Consumer Price Index, or CPI report. This is the defining fork in the road for the market right now. We basically have two very strict if-then scenarios playing out. If the month-over-month core print comes in cool at 0.2%, the bulls win, the AI euphoria takes over, and the rally remains fully intact. But if inflation comes in hot at 0.4% or higher, the bears take control, and we could immediately see a 2% market correction. Literally everything hinges on this single data release.
As we head into that crucial CPI data, I want to give you some concrete lines in the sand to watch on your screens. 8,000 is clearly the big bull target if the data comes in cool. On the flip side, 7,600 is your critical support level. That is the absolute line in the sand. If a hot inflation number breaks us below 7,600, things could get ugly fast, and we'll likely test 7,500 very quickly. Knowing these levels is what allows you to read the market's reaction in real time, completely removing the emotion from it.
Which brings us to the final thought I want to leave you with today. We've got historically strong earnings momentum pushing us forward, but historically extreme valuations holding us back. So what's it going to be? Momentum or valuation? Which one will break first? The data this week is going to write the next chapter of financial history, and whichever side wins this tug of war is going to dictate the trend for the rest of the year. Thank you so much for joining me for this explainer. Stay focused, keep a close eye on those key levels, and I'll catch you next time.